unfortunately, there's a lot of people who don't learn from those mistakes and don't learn from those errors, and they tend to repeat them over and over and over again, and they eventually find themselves, Steve, what we say in poker, they find themselves on the rail.
You're listening to Traders Insight Radio by Interactive Brokers. Find more podcasts and daily market commentary at tradersinsight.news. Please remember, any trading discussions are for information purposes only and are not intended to portray recommendations. Please listen to further disclosures at the end of today's episode. Now, welcome to our show. Let's get started.
Hi, everybody. Welcome to Interactive Brokers Traders Insight Radio. This is your host, Steve Sosnick, Chief Strategist at Interactive Brokers. With me today is my friend Bob Lang from Explosive Options, and I'm going to let him introduce himself very briefly. He and I have, we've met in person, though we really actually became friendly via Twitter and interacting that way. And take it away, Bob. Tell us about yourself.
Thanks, Steve. It's great to be with you today. Great to be with all the listeners today as well, too. So as Steve said, I run a company called explosiveoptions.net, and I've had this company for about a little over 11 years now. And as you probably could understand from the title of the company, it's about trading options. And we try to do it in a way of helping people learn how to manage risk in a way that allows them to become profitable trading options. I know options trading is a huge mystery for some people out there. They don't really understand how it works and the applications involved, the execution, and that sort of thing. And there's some ways to make money trading options. So we try to teach people how to do that through my service and through an amazing chat room that we have. I have used Interactive Brokers as my broker for my clients for several years now, and so it seemed like a natural process here to talk with you, Steve, and very excited to be here.
Tell the listeners how you interact with your customers. I've actually had the privilege of being out with you where you invited me to a customer event where we're at a great time meeting not only you and your lovely wife, but also just, various of your customers. Tell us how you interact with them and how you keep them on the straight and narrow, as it were.
Well, I put a lot of information, Steve, out on the internet, especially on Twitter and social media, and because I know there's a lot of people out there listening. They're hungry for learning, and they're hungry for understanding how to make money. And there's a lot of people out there who don't have a large sum of money, and they hear that trading options, you can make a great deal of money with a very small capital base. So we try and teach people to be diligent, to be responsible, to manage risk appropriately. And I find these people, Steve, I don't do any marketing at all. I don't do any, I don't spend any money doing any marketing other than what I put out there on social media and put articles and webinars and interviews together and share things with people. I've been doing this for a long time, and 20 plus years, and through my years I've learned a lot about how to make money. I've learned a lot how to lose money, and I think it's the combination there that has kept me in the game, kept me grounded, and kept the ego out of my trading. And so I try to share my experiences with people, and I try and keep it real, and hopefully people see that, hey, look, you know what, that happened. They can hear something that that happened to me recently, or even 5-10 years ago. They might be able to say, hey, that's me. He's talking about me. I did the same thing. This guy's been around for a long time, and I'm making the same mistakes that he did. Okay, I got to find out more. And that's how it starts. People come in and they come to the chat room, or else they follow me on Twitter or elsewhere, and they feel like this has become their home, and so that's kind of how it starts.
It's a very interesting point that you bring up, because I think a lot of people think about options as a vehicle for speculation, and I've always found that I think you learn more from mistakes than you do from the wins, because a lot of times you can win because of luck, or you could win because of skill, but it's often difficult to distinguish the two. One of my favorite phrases is "Don't confuse a bull market with brains," because that happens a lot of times. And obviously, it's much cheaper for your customers if they've learned from your mistakes, which we all have. Let me not say anybody. Let me not single you out as being alone with mistakes. But I think that's a great way to impart wisdom to your customers. Is by here's where I've made a mistake. Don't make the same one, or this is a situation that has a pitfall. Tell me some of the ones that you've been working on with your customers recently.
Yeah, so I think people have to understand that trading is not a game of perfect, and if you make a mistake, if you make an error, and it's correctable, then you at least have a chance to turn around and fix it. I think one of the most important aspects of trading options is to be able to, when you have control, you don't want to lose. You want to give up that control to the markets, or you're gonna lose a lot of money and eventually get booted out of the game. So what I mean by control, I mean we oftentimes put trades together, and we think that they're much bigger and much greater than they end up turning out to be. And that means that we tend to want to put up more capital because we want to have bigger wins. We feel that trades are going to be that pot of gold at the end of the rainbow, and it's certainly never, hardly ever is the case unless you get lucky. But we can't rely on luck to be successful over long term in this business. So I think if you make a mistake, you make an error, and you can correct it, you can learn from that and move on. But unfortunately, there's a lot of people who don't learn from those mistakes and don't learn from those errors, and they tend to repeat them over and over and over again, and eventually find themselves, Steve, what we say in poker, they find themselves on the rail, which means outside the game, they're watching and they're not participating in the game any longer.
Yeah, because the problem with options from the long side, we can talk about options from the short side in a minute, but even with options from the long side, people focus on the fact that it's a leveraged return. You have a fixed, if you're just buying a naked, an outright call or an outright put, you put up a fixed amount of money for what the hope is of a leveraged return. And, that's a very easy and seductive idea for people. But unfortunately, it appeals to a lot of gambling mentality. And gamblers don't overall have a great track record. And so how are you imparting the idea that if you're trading from the long side, a lot of times the odds are against you, and how do you overcome that?
So the gambling analogy is very appropriate because much like options trading, it's risk taking, where you're risking a certain amount of money to make other money. But the difference between options trading and, say, a hand of blackjack is you have no edge at the blackjack table. The house holds every edge against you, from 51% or higher, right? Whether it's craps, whether it's the slot machines, or whether it's the roulette table or blackjack. The house holds every single edge against you. But or at least in options trading, you can create your own edge against the markets and against other people, and have a system there that can be a consistent winner as long as you're disciplined enough. Look, I mean, again, we're taking a risk over here. However, if you could do it in a smart way, in a more managed way, and the risk that we take is to get that advantage that you talked about, the leverage that you have with options, to get a much better return than you would otherwise in playing a stock, making a stock play. I think the similarity between options trading and gambling or the casino is very appropriate, because a lot of people have that casino mentality. They want to get in there and they want to take a risk and be a player and take some money from the casino. But the casinos weren't built because they lost money. In fact, if you go to a casino and you're at least the difference between a casino, I guess, and options trading, Steve, is at least a casino you'll get some free drinks.
Exactly.
And they won't tell you when it's time to leave because there are no clocks in a casino. So,
On the other hand, the options market is the one place that won't kick you out if you win consistently.
That's right. You can keep going and going and going if you have a consistent methodology. And so that the control and the discipline that I was talking about earlier is about managing risk. And I think a lot of people, don't know how to manage risk. And we're talking about position sizing. I think sizing your positions appropriately for the amount of risk that you want to take is absolutely essential. It's crucial to the success for an options trader. And I know it may be boring for some people to say, look, I should only buy one option, but I want to buy 5. Well, if you can only buy one option, then you should buy one option. And if you lose, and again, the odds are against you when you're a buyer because of the decay factor. If you happen to win, at least you can compound that and start, stringing some wins together. You don't have that opportunity when you're at the blackjack table, because again, if you win 5 hands in a row, that's not correlated with that 6th hand, which could be, and you throw all your money out on that 6th hand, the dealer gets blackjack and you're done. So.
Yeah, no, that's true. So following that along, do you find yourself being a bit more of a trend follower or counter trend trader? Because Mark, there's the random walk element to the markets, but markets do have a memory, and there is trendiness in a market. Do you tend to be more of a trend follower or a counter trend trader, or just opportunistic in either direction?
Yeah, you talked about the whole random walk thing, and one of my favorite books is The Random Walk by Burton Malkiel.
Of course,
I'm sure you read that book. Great book. So I would call myself, Steve, I'm a trend follower.
Okay.
But one of my mentors who I learned a lot about technical analysis from is Dave Landry. And he kind of coined himself affectionately the trend following moron. And I learned a lot about why he was a trend follower for such a long period of time. And he basically said that you can find the best moves when a stock or a market is trending. And then I realized about tops, and the counter trend player is looking for tops and bottoms. And then I looked at some charts many years ago, and I realized that a stock, when it's continually going down, 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 is a collection of bottoms. So, and how do you know that you're picking out the correct bottom that the market is going to turn from? You don't. It's a guessing game. And much like, Steve, you remember back in 2008, 2009, when the markets were making lower highs, lower lows, day after day after day, and people were continually going on TV and financial media and so forth and telling you this is the buy of the century, you've got to get in there and buy it, and we just continue to go lower and lower and lower. How did they know when the bottom was going to be? And then finally, 4 or 5 months after the election in March of 2009, well, we hit 666, but we were down 40% the prior 4 or 5 months. And if you kept buying that, reaching for that falling knife over and over and over again, you got pretty bloodied up. Over a long period of time, was that a smart buy? Absolutely, no question about it. But I would rather be on a trend. I mean, I could have waited for that bottom to come in 3, 4, 5, 6 months later, and ridden a trend and still made a nice chunk of money, and not having lived through the pain of losing money during that time when the markets went down.
Oh, one of the things that I've been fairly adamant about in my work is there's only one true bottom. There are any number of short-term bottoms or bottom-like events, but there's only one. And I think the idea of trying to go all in, which goes back to your position sizing, just because you think, okay, that's the bottom. Remember in March of 2009, it felt miserable. It really felt like we were never going to have an up day again, which of course that's the capitulation. Not before, none of this false enthusiasm. And I think that's what we have to be very wary of right now. Could we have seen the bottom? Yes. Do I think we're likely to have? We'll get to some of the stuff about the Fed and other stuff as we go on. But I don't want to lose sight of the position sizing, because this is very important to many people, and it's a tactic I think people don't understand. How do you advocate that? I know there's sort of the old Bill Gross method of, don't put more than 2% into any one position. Obviously, with options, it's different than if you have a bond portfolio. How do you work with your client base toward finding the optimal position size for a given portfolio?
Well, there's the old adage: if you can't sleep at night, you clearly have too much exposure and too much risk on. So, I mean, maybe for some people it's selling down to the sleeping point. I tell people, look, I mean, what are you willing to lose? I mean, for some people, let's say, Steve, they have $100,000 portfolio. They're willing to risk $1,000 of a total loss, and then they're willing to say that's it. So that's 1%, right? And you can risk $1,000, and you can make a much larger sum of money. You can make $1,000, $1,500, $2,000. But of course, you're capped off at that $1,000 risk. That's the thing. The beauty about options is, you can only lose what you put into it. It's defined risk. But as far as the position sizing is concerned, listen, I've over my years, I've heard from everybody. People who've had they come to me and they say, Bob, I've got the winning method. It's a black box theory, a methodology here. I can't lose. I've back tested it for 10 years. It's an absolute winner. I can't lose. All right. And so they go all in, Steve. And the next call I'm getting is, oh my God, what did I do? I can't believe it. I lost it all, because and it's because you believe in something, and that's great to have conviction in it, but risk management rules always are the priority. They're always the most important thing. You can have the best system in the world. Listen, I'm sure you remember back in 1998. What was the talk back then in the fall? It was these brilliant geniuses from long-term capital management, the smartest people in the world, were making gazillions of dollars for their clients. They took excessive risk, and they almost took out the whole financial markets. If people don't remember, this actually setup was even worse than in 2008.
I remember that, because as someone who was helping to manage a very, very successful black box, which needed, by the way, to be constantly fed and maintained and reassessed, and with very strict risk limits for each, for positions. Even then, it was tricky, because the lack of liquidity meant that some of our positions, we actually did fairly well in that one. We tended to be long gamma, long downside, and tended to do well in these kind of events. But there were the questions of, okay, well, you guys are long a whole bunch of leaps, and they're illiquid. Where do you mark them? It is in a crisis like that. Even if you're right, you can end up in a sticky situation. So I remember that, and being here in Greenwich, they were in Greenwich as well, and I remember taking the train to work one day, and the conductor's like, next stop, Greenwich, Connecticut, home of everyone's favorite hedge fund.
Yeah, John Merriweather, right?
I knew a lot of those guys. My first job was at Solomon Brothers, so I did know some of those people. It was I'm going to call it market hubris. These were literally the smartest guys in the room. Two of them were Nobel Prize winners.
That's right. Yeah, and so the thing is that you get people, the most brilliant people in the world, even they can trip up and cause bad things to happen, just because of that, of the nature of trying to get large enough and big enough. It was you can never be big enough for everybody else. So
I always like to remind people the market can remain irrational much longer than you can remain solvent.
That's right. Yeah, John Maynard Keynes, right, some 100 years ago, said the same thing. So,
yep, and that was and those Nobel Prize winners must have skipped that part of his book.
Yeah, no doubt.
So now, your clients tend to trade from the long side. You don't involve them in very many writing strategies. I guess as a trend follower, you might as well follow the trend and lever on it as opposed to to writing. Do you do much writing with your clients?
Sure. I think that's one of the easiest ways to take some risk off on positions. So if I have some stock positions, immediately what I'm doing is I'm looking to write calls against it. That's the easiest, most plain vanilla way to use options. But for the most part, I look at lots of different option strategies, Steve. Something because there's three different options types of trades. There's one for volatility and direction and time. The three different ones, and I use them all. So when we're looking for a big volatility move, I'm entering strangles or straddles. These terminology here, of course, maybe a little bit foreign to some people, but
they can always come to IBKR campus and learn all about our various learning tools for option strategies. Sorry, had to throw in the plug there.
It's a great place to learn all of it. I've been there myself. It's a great place to learn new language and new terminology to help you on your way of becoming an options trader. So it just depends on what we're doing as a trend follower. Like I said, I look for different opportunities for what the market is telling me to do, and I don't tell one thing more recently I've been talking with people, and they're trying to force their own viewpoint on the markets. And I read an article last week, Steve, said basically this is the moment in time during a bear market where the most people are going to get hurt. And it's because we've had this bear market, let's say it's been going on since the beginning of the year. Well, we made our all-time high on January 3rd or January 4th, and we've just had a steady decline ever since. And so we could say we've been in a bear market for the better part of 7 months, probably a little bit longer, but let's just say since the beginning of the year. People are frustrated. People are exhausted. They're tired of this bear market. They're tired of this behavior day after day after day. It's just, people are waking up, okay, they wake up and they say, how much money am I going to lose today? Because they're defeated. And people just want this to be over. So I think where people lose money, Steve, is they say to themselves, all right, well, I'm going to do whatever I can. I'm going to figure it out if I'm going to use technicals or whatever, but I'm going to make sure that the market is going to move up in my favor. And it's irrational. It's really illogical. It's irrational to tell the markets what to do, but that's what people are going to do. And they're going to lose a large amount of money, and they're going to end up, in a whole world of hurt here.
The markets do not care what you think about them. That's really, what? You've learned that lesson the hard way, I'm sure. I know I've learned it the hard way. The markets, my point of view is one of many, and you have no other choice but to recognize if you're wrong and recognize it very quickly, and most importantly, recognize that you cannot impose your will on the market. Long-term capital, again, I hate to bring them up again. If anyone could impose their will on the market, it was those guys, and you couldn't. Sorry, sorry, didn't mean to take away your train of thought on that one.
No, you're exactly right, and I think that most people right now they have a great opportunity to step back and sit back and wait for what's going to be on the other side of the wall. Because we always know that a bull market comes around eventually. Bear markets don't stay around for an extraordinary long period of time, but it has to play out. And a fellow that I know you may have known personally, Marty Zweig, once said that. Don't fight the Fed. And he said a whole lot of other things that really crystallized me in terms of understanding markets and behavior and psychology. But this one thing that he said, don't fight the Fed. Well, if the Fed is in hawkish mode and they currently are right now, if that's just to dumb it down a little bit, why fight the Fed? Why do that? So you have to wait till this whole thing plays out, because we know at the end of it's a game of survival here. If you can survive through this bear market to make it to the next bull market, it'll be much more of like an oasis than it is right now.
Well, you've hit upon one of my most common themes. You and I think are very copacetic on this one. I've been saying this quite a bit. If don't fight the Fed was your mantra on the way up, it kind of needs to be your mantra now. And until or unless we see the Fed, I'm not even going to say step on the gas, but at least take their foot off the brake. I don't see how it's an environment that lends itself toward going all in on the long side. Yeah, there's always going to be opportunities. And you and I each have trading mentalities, and we know that there's always opportunities, even in a bear market. There's certainly, trading opportunities. Stocks that are in a downtrend can bounce, and they can bounce for longer. Bear market rallies, short, sharp, and ferocious. They can sucker you in, but they can also give you some opportunities. But I think overall, as an investment thesis, I can't agree with you more, because it's been something I've been advocating for some time, which is the Fed is not your friend right now, and so don't fight them. Going back to the idea of, you might think one thing, but the market's going to think what it thinks. It's going to do what it's going to do, and if the monetary tide is flowing out, it doesn't really matter. It doesn't really matter. It's very, very hard to fight that.
I was going to say, the monetary tide that you talk about is extremely important to understand that, even with the proliferation of algo traders and program traders and that sort of thing these days, let's not forget 80% of the money that flows into and out of the markets is institutional. We're talking mutual funds, hedge funds, big banks, pension funds, charitable trusts, that sort of stuff. 80% of the money that's flowing in or out. And if they're not in the game right now, let's face it, a lot of this money has been pulled out over a long period of time here. And if they're not in the game, these are your long-term investors, the ones who have the insight and the foresight to get in early before market prices go up. They're like the big elephant in the room, And excuse my French, Steve, I always like to tell people, I like to be a fly on an elephant's ass. I like to be riding that elephant along, because look, when he steps in water, everybody gets. So I want to be riding along with that elephant when he's putting money to work. He's not putting money to work right now, and so I can identify that. I can see that and say, okay, if he's not playing, then why should I be? So it's a matter of being patient and waiting, and not anybody necessarily getting me a phone call and saying, hey Bob, we're putting $70 trillion worth of money into the markets today, just letting you know. I don't get that phone call.
No, I don't either. I've been waiting by the phone for that for years.
For years. The signals and the signs will be there as long as your eyes are open and you're ready. And again, going back to risk, if you're out of the game, you're not going to be watching for those things because you don't care, because if you're out of the money. So that's why I tell people, just be patient, just wait. If you don't want to play the bear market, fine. Step out, step back, and wait for your moment to get back in, because some point in time, it'll be there.
Well, Warren Buffett often has referred to cash on the sidelines as a call option. Gives him the opportunity to step in and buy, and I think that's important in this environment. Going back to the institutional aspect of it, one of the questions I get asked a lot, and I'm sure you get asked it a ton as well, is, why isn't VIX higher? One of the thoughts that goes through my mind is institutions have largely de-risked, and so they don't need to buy as much volatility protection. Do you subscribe to that idea?
That's absolutely 100% correct. And why does somebody if you're a big institution and you, again, as you said, you de-risk, why do you have to buy protection against your cash? That's really essentially what people are saying. I'm going to buy volatility because I'm going to protect myself against my positions going down. So it's a completely different situation here. So, and again, this goes into my theme, what I talked about earlier, about why this is the most toughest part of the bear market right now. Because normally in a bear market, you see rising volatility and you see big movements. And now, of course, what does rising volatility mean? When the VIX goes up, it means option prices become expensive, right? Puts and calls. But when volatility is coming down, it means everything's inexpensive. And so you would think that if put options are cheap along with call options, okay, well, give me some puts. But if the market is telling you that you're not going to get those ginormous moves like we've been used to over the past couple of months, well, that's a dilemma too. So, I mean, if you're trying to buy some protection or else just play a directional move, you're not going to get the bang for your buck like you would normally get. And in fact, when volatility is low, you have the chance that the trend, if it's going down, is going to reverse on you really, really quickly. Look what happened last week. We had We had before last week, Steve, we had about 10 out of 12 weeks that were down out of the past 3 months. We had that big, huge week last week. We're reversing right back down today. The market volatility is not moving very much at all either. And in addition, Steve, I would tell you this, is that one of the reasons why volatility is down is because the uncertainty factor has been lowered as well too. So what does that mean? That means that we all know that the Fed is going to be raising interest rates. I think if you didn't know that, you've been living under a rock. We also know that the economy is soft, and we are likely going to print another negative GDP number on Thursday morning, to the technical definition of a recession 2 quarters in a row. But I think that people really understand that the economy is weak right now, and earnings are going to be weak. So people know these things. The surprises aren't necessarily going to happen to pop volatility and these and shock everybody.
Let me just state for those who might be listening to it further on, we are taping this the Tuesday that the first day of the 2-day Fed meeting. So as of now, markets were widely anticipating 75 basis points. By the time you're listening to this, we'll know the answer to that for sure, and we'll also know what the GDP print is. But yes, broadly speaking, I believe that to be the case. I was asserting recently that VIX is probably about right, considering the type of intraday moves we've been having. We do tend to see, high-low intraday, certainly 1% or more are not uncommon. 2-3% is not uncommon. So when you think about VIX being, mathematically speaking, the market's best estimate of volatility over the coming 30-day period, yeah, it's about right. It's not too cheap. It's not too expensive. I called it a Goldilocks VIX. I do think that while you're going to be susceptible, you're always susceptible to a jump because VIX tends to take the elevator to the roof and the stairs back to the lobby, kind of the opposite of the market. I think it's tough. It's not unfairly priced. Do you broadly agree with that? What's your take on that one?
No, I agree with that. And in fact, if you look at other aspects or derivatives of the VIX, and one is called I hate to get all technical here on you, the VIVIX, VVIX, which is the volatility of the VIX. It's basically a derivative of volatility, and that is really extremely low right now too. So this indicator is telling you that no, you should not expect a huge amount of volatility in the markets, which is kind of explained by as well by what we call the skew index. And the skew index tells us where the outlier bets are being made. When that skew index is rising, that means people are speculating that we're going to have large moves in the markets, and the skew index is actually rather low. So you have a couple of these other indicators, Steve, that are confirming to you the fact that the market volatility is low, should be low, and is priced just about right. So I would agree with you.
Okay, well, we have another month or so of summer to follow, and we'll find out about that one. I'm getting the little motion from our producer that I knew this was going to happen. You and I could talk for an hour or two, but we pretty much have about a half an hour as our goal for the podcast. Anything else you'd like to wrap up with? Anything else that you'd like our listeners to know about you, just as a final wrap?
Well, just that I put a lot of information out there and try to help educate people because I realize that this is a difficult task to do. I think options trading, could, if you learn what you're doing the right way and take your time, it's an endless journey. I'm learning something every single day. I've been doing it for a long time. I know you too. You learn something every day as well. It's endless learning. It's just it's a fantastic way to earn money and grow your wealth in a way that's unmatched by anything else in financial markets. That includes crypto and foreign currency. So I think that options trading is a fantastic place to be, and I hope people get a chance to see what I'm doing. I have this book I wrote called Know Your Options, and kind of it's a soup to nuts about options trading from start to finish. It tells you how to get started and get you working on technicals and so forth, all the option terminology and language and so forth. And it's a great starter book for anybody who wants to get going. I think most people, they could read that book and get going and open up a trading account and get moving right away. So, but that's I think I'm excited. Every day I wake up in the morning, I'm excited that I have an opportunity to make a buck and in the options market. And until that goes away, I'm motivated every single day.
And just, again, please remind the listeners of your website and your Twitter handle, all the good stuff, and when they can find. I know you're on thestreet.com periodically. That's where you and I met. And I know, Jim Cramer features your work from time to time. Just make sure everybody has your website and social media handles.
So my website, Steve, thank you, is explosiveoptions.net. As well, on Twitter, my handle is at Aztecs99, AZTECS99. I went to San Diego State, so they're the Aztecs, so I use that as my handle. And right, as you said, for thestreet.com, Steve, we met and did an interview together, and it was just a wonderful interview. And it was so great working with you in that time, and I'm glad we got a chance to do it again. And I run Action Help. I'm one of the two guys who run Action Alerts Plus for thestreet.com, which is their big flagship product that Jim Cramer ran for many, many years, started it with the charitable trust. He's moved on, of course, to CNBC. Chris Versace and I took over the product in October of 2021, and we've been running it ever since. And we're doing pretty well. We're about in line with the S&P 500, and we're holding a lot of cash. We have some reserves as well too. Got some good plays in there, but that's also another place you guys can find me.
Well, I urge you all to check out some of the places that Bob told you where to find him. He and I have an ongoing discussion, and I'd love it if the more listeners who joined our discussion, the better. Just to wrap up, again, my guest was Bob Lang of Explosive Options. This is Steve Sosnick of Interactive Brokers, and I wish you all adieu. Thank you very much for listening, and we'll be back again with another podcast soon. Thanks, everybody.
Thanks for listening to Traders Insight Radio. As always, there's more content at tradersinsight.news. And if you're interested in learning more about Interactive Brokers, visit IBKR.com. We offer more trading education materials such as webinars at ibkrwebinars.com, market-related courses at tradersacademy.online, and quant-related articles at ibkrquant.com. The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. The material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and if necessary, seek professional advice. Options involve risk and are not suitable for all investors. For more information, read the characteristics and risks of standardized options, or ODD, which may be accessed through the link found in the show's notes or podcast description page.